Banking, Housing, and Urban Affairs will come to order. Today's hearing, as many have been in the past, is in a hybrid format. Our witnesses are in person. Thank you for joining us, and members have the option to appear either in person or virtually. Financial fraud and schemes have, as we know, always been with us. In fact, they're older than money itself. Criminals have always found inventive ways to cheat people out of money that they've earned. Crypto is no different. Scams that have persisted in the securities market can easily be translated to crypto assets. They may seem even more enticing to potential victims when wrapped in a new technology and with the promise of quick and outsized returns. In the early years of Bitcoin, scammers hacked exchanges to steal from early adopters. It didn't take long for crypto fraudsters to figure out Bitcoin can be used for old-time schemes and frauds like Ponzi schemes and bogus investments, promising big returns with only upside and no risk. Back in March, this committee looked at how cryptocurrencies could be used in illicit finance like terrorism and human trafficking. Today's hearing considers how the increasing presence of fraud and speculation in the crypto and securities markets threaten savers and investors. In the last 2 months, we've witnessed spectacular blowups in the crypto markets, exposing both the alarming interconnectedness and the enormous risks among crypto firms. Consumers and investors were misled with promises that their crypto would earn double-digit interest rates in perpetuity. Think back to multi-million-dollar Super Bowl ads and think about whom they were targeting. One collapse after another revealed how quickly supposedly stable investments could fall apart. We saw that unregulated and unlicensed entities could both borrow and lend hundreds of millions of dollars to engage in risky crypto trading. Our witnesses are all too familiar with fraud and risks in the growing crypto markets. They've been on the front lines in the security markets, chasing bad actors, exposing frauds, educating investors and investment firms. While the work of state securities regulators and Finra is always important, it's especially critical during periods of market volatility and economic uncertainty. Those are the times when diligent savers see their retirement accounts decline and offers of supposed guaranteed profits or, quote, no-risk investments sound even more tempting. Crypto's appeal is surely understandable. Promises of double-digit interest and lies about FDIC insurance or SIPC protection entice Americans frightened by volatile markets and worry about retirement or bills that are piling up. Times of crisis also create opportunity for those looking to exploit economic anxiety. In the early days of the pandemic, all of our financial watchdogs began issuing warnings about COVID-19 related scams, from frauds connected to investments tied to vaccines to sales of useless PPE. Fraudsters used our fears to steal and to cheat. And our witnesses are perhaps more aware of that than anybody in the room. Our witnesses today will discuss scams and frauds that target vulnerable groups or close-knit communities where trust and pre-existing relationships can be abused. This is another area financial watchdogs know all too well. Seniors and other vulnerable Americans are too often the victims of scam artists peddling Ponzi schemes or using high-pressure tactics to get victims to part with their money right away. This committee's seen the predatory behavior that targets service members looking for affordable short-term credit who are instead sold high-cost payday loans. Bad actors touting supposedly safe investments use similar predatory methods to defraud military families. And we know these frauds, these examples are often underreported. Victims blame themselves or don't want to admit what happened. We have to fix that, and Ms. Walsh will talk about that today. Thank you for that. American markets are the envy of the world. Our diverse economy and the rule of law help families and workers save for the future. We have to keep it that way. That's why law enforcement and our regulators, like our witnesses today, must be alert. They must be able to identify scams and move quickly to punish bad actors. Just last week, the FBI issued a warning for financial institutions about cyber criminals creating fraudulent cryptocurrency investment apps. Agents found hundreds of victims who collectively lost tens of millions of dollars. And we knew that's just the beginning. There are victims and more losses every day. My colleagues across the aisle seem a bit confused about where our priorities should lie. Our markets are the envy of the world because of, not in spite of, the ways we protect Americans' money. Suppose that innovation and opportunity don't mean much if they come at the cost of massive fraud. New ways to cheat people out of their money is not the kind of innovation most people want in our economy. We hear industry players call for rules of the road when a big fraud's uncovered and after a big actor has knowingly violated the law. The rules are there, the roadmap is clear. This committee needs to make sure our regulators enforce the law and protect the workers and families that keep this economy going and markets running. As this committee and the American people learn more about crypto-based investments and understand how scams and frauds are growing, we will push our regulators to do more. Of course, that means the SEC. It also means the banking regulators. Industry shouldn't be allowed to write the rules that they want to play by. Senator Toomey.
Thank you, Mr. Chairman, and welcome to our witnesses. Our hearing today looks at scams and risks in the securities markets with a specific focus on crypto. And given the recent collapse of an algorithmic stablecoin and the bankruptcy of several crypto lending platforms, this is a well-timed hearing. And of course, one would think that we'd hear from the SEC, the primary federal regulator of securities, especially considering that the chairman there considers nearly every cryptocurrency to be a security. That's the request Republicans made. Now, there must be some good reason why Chairman Gensler or one of his subordinates can't appear before the Senate Banking Committee to explain what the SEC was doing while several crypto lending platforms, including Celsius and Voyager, imploded, especially since the chairman himself would very likely claim that these companies fall entirely into his jurisdiction. Our Democratic colleague said he's not testifying today because it's possible that he may appear at the committee this fall. Well, that's little comfort to the thousands of Americans who lent their crypto to Celsius and Voyager, some of whom will be unsecured creditors now in those companies' bankruptcy proceedings. What was the SEC doing? While these companies and others were offering lending products that looked an awful lot like securities. And what's the SEC doing now to help ensure the crypto community gets the regulatory clarity it has repeatedly asked for? People, we all deserve answers now. We deserved them a long time ago. And Chairman Gensler has the answers to those and other questions. He just refuses to share them with us. Now, it's clear that some Americans invested in unsustainable schemes and even fraud, and we need to investigate that fraud and prosecute any violations of the law. But since at least September of last year, I've argued that some digital asset projects were offering returns that didn't make any sense to me, and that some of these endeavors would inevitably end badly. Well, over the past couple of months, those risks became reality. As I mentioned, Celsius and Voyager were offering interest rates as high as 18% if customers would lend their digital assets to these companies. Well, the firms would then lend that crypto to other larger investors to make short-term bets on crypto markets. Well, once the crypto sell-off began, the borrowers couldn't pay their debts, the platforms froze customer accounts, and now both companies are in bankruptcy and investors are staring at billions in losses. These circumstances beg the question, where was the SEC? Had the SEC responded to calls for clarity on how it would apply existing security laws to novel digital assets and services, something that I and many others repeatedly asked for, things might have been different. For instance, the SEC could have said how it intended to apply the Howie and Reeves tests, which the SEC uses as a primary mechanism for determining when something is a security. The Howie test has 4 basic prongs in determining whether something is a security. To be a security, there must be an investment of money in a common enterprise with a reasonable expectation of profits that are derived from the efforts of others. Well, it seems like the crypto lending products that I've mentioned had all 4 of these features. The SEC almost certainly believed that too, because in February they went after BlockFi for offering a similar lending product. Here's the problem with the SEC refusing to publish regulatory clarity about when digital assets or services are securities. In the absence of that clarity, you're left with this ad hoc approach to consumer protection known as regulation by enforcement. Now, there are at least 4 problems with this capricious and unevenly applied strategy that the SEC is pursuing. 1, it's a serious challenge for any well-meaning innovator striving to comply with existing laws and regulations if he doesn't know how they'll be applied. Number 2, it stifles innovation. Market participants who lack the benefit of understanding the SEC's thinking prior to designing a product They may never create something that could be very useful to consumers out of a fear of how the SEC will interpret it. Number 3, creates a legal gray area that allows entities with a higher tolerance for legal risk to offer products that might be very bad for consumers. And number 4, it's ineffective. Just ask those who lost money on these crypto lending projects. Let me give another example. When the SEC announced insider trading charges involving a former Coinbase employee last week, it claimed that the offenders had illegally traded 9 digital assets that were securities. Now, the SEC, finally, in their complaint, they lay out the reasons why they believe these digital assets are securities. I'm very skeptical of their arguments. Yet they've still failed to disclose the rationale publicly before launching the investigation. That kind of approach is patently unfair to investors and developers alike. So Republicans have been arguing for a more thoughtful approach to regulating digital assets. The first place where we should be able to find common ground, and I actually think we're, in many cases, are close, is to chart a path forward for clear, sensible regulation on stablecoins. There's a clear bipartisan agreement that stablecoins should have consumer protections. There are virtually none now. I've proposed a framework to do that. I'm in discussion with several members to make this proposal a bipartisan one. Let me conclude with this. It's absolutely essential to investigate any fraud in the crypto market and any violations of existing law and prosecute those who are committing those crimes. So while I appreciate today's hearing topic, it's a missed opportunity without having the SEC here. Moving forward, I hope my colleagues will take a balanced look at these technologies, studying both the consumer risks that we need to deal with, that we'll, I think, hear about today, but also the enormous potential for consumer benefits that distributed ledger technology could bring. Thank you, Mr. Chairman.
Thank you, Senator Toomey. I'll introduce today's witnesses. Today we'll hear from Melanie Lubin. She's member of NASA's Board of Directors and NASA's 2122 president. She's a 36-year veteran of the Division of Securities within Maryland's Office of the Attorney General. In 1998, she became the Maryland Securities Commissioner. Our other witness, Gerri Walsh, is Senior Vice President of Investor Education at the Financial Industry Regulatory Authority, where she's responsible for the development and operations of Finra's Investor Education Program. She also serves as president of the Finra Investor Education Foundation. I'll begin with you, Ms. Lubin. Thank you for joining us.
Thank you, Chairman Brown. I want to thank the entire committee and its dedicated staff for organizing this hearing. I'm honored to be here today on behalf of the hardworking state securities regulators who, in each of your states, are charged with protecting investors, with promoting responsible capital formation, and with supporting inclusion and innovation in our capital markets. I'm also honored to share NASA's perspective regarding the primary threats to investors in today's securities markets and ways to mitigate these threats. At this time, and based on available information from our members, we believe that the top threats to retail investors are 1, fraudulent investments tied to digital assets, 2, fraudulent offerings related to promissory notes, 3, scams offered through social media, 4, scams otherwise offered online, and 5, financial schemes connected to self-directed individual retirement accounts, or SIDRAs for short. With regard to digital assets, we are particularly concerned by recent events, including bankruptcies and collapses of several digital asset businesses. As we discuss these and other threats today, I urge all of us to consider the greater context in which we are having this discussion. Nearly 15 years after the 2008-2009 financial crisis, a concerning amount of distrust in our regulated capital markets persists. In a recent survey, the percentages of Gen Z, Millennial, Gen X, and Baby Boomer respondents who expressed trust in Wall Street ranged from 32 to 36%. That's hardly a vote of confidence. In another survey conducted in March 2021, among those invested in the stock market, including those invested through retirement plans, an alarming 56% agreed that the markets are rigged against individual investors. Moreover, evidence suggests that the distrust of our regulated capital markets is higher among communities of color. In my view, we may be at a tipping point in the history of our capital markets. The choices we make in the next few years may affect our ability to sustain these markets for generations to come. To ensure that our markets continue to grow for the benefit of businesses and investors alike, We need to do an even better job at promoting lasting trust in and informed use of the regulated capital markets. Promoting lasting trust starts with making improvements in how we prevent and detect investor harm, and how we ensure that those charged with enforcing the laws have the tools needed to do the job. The Empowering States to Protect Seniors Against Bad Actors Act, which would establish a grant program at the SEC for state securities and insurance regulators, is a terrific example of legislation that would help achieve those goals. Promoting lasting trust also means that we must make sure that regulators have the tools and resources necessary to accomplish our investor protection missions. Legislative efforts to weaken regulatory oversight will not serve the best interest of investors. This is true regardless of whether the legislation relates to traditional or emerging areas of our markets. When it comes to regulation, we believe in a robust policymaking process that may or may not reveal that we need to supplement certain areas of the law. Thus, Congress should oppose rushed legislation relating to digital assets that merely serves to offer special treatment to certain market participants and that weakens the importance of state and federal securities regulators in our economy. For our part, we are participating in efforts associated with the President's executive order, including meetings with our federal regulatory counterparts. We engage regularly with SEC Chair Gensler's staff on digital assets, including the crypto rulebook project that the chair is spearheading. Within NASA, our members discuss and share experiences they have with various local legislative frameworks related to digital assets. In closing, I want to urge Congress to oppose efforts underway to pass legislation that would restrict or limit the role of regulators, particularly state regulators. As I explained in my written testimony, efforts to further expand the markets with limited or no regulatory oversight, coupled with further limiting state authority, is dangerous for businesses, for investors, and for our capital markets. This approach is simply a recipe for producing additional distrust by the very investors we are supposed to be protecting. I look forward to your questions. Thank you very much.
Thank you, Ms. Lubin. Ms. Walsh, you're recognized for 5 minutes. Thank you for joining us.
Chairman Brown, Ranking Member Toomey, and members of the committee, on behalf of Finra and the Finra Foundation, thank you for the opportunity to appear today to discuss the risks investors and savers face in today's securities and crypto markets. Finra's mission is to protect investors and promote market integrity. In my role as president of Finra's Investor Education Foundation, my team and I focus on research and education to help Americans achieve their investing goals, navigate increasingly complex financial markets, and avoid fraud. In my testimony today, I would like to emphasize 3 points. First, Finra and the Finra Foundation have dedicated significant resources to combating financial fraud. My written testimony details the extensive oversight activities and strategies that my colleagues at Finra use to look for misconduct or fraud by broker-dealers and to take action when we find it. Second, in carrying out fraud, bad actors often capitalize on trending investment practices and vehicles. For example, social media has become a powerful medium for investing, but it also can be a vector for fraud. And the number of bad actors exploiting the hype around cryptocurrencies and digital assets has surged. According to the Federal Trade Commission, fraud using crypto as the payment vehicle increased 5-fold between 2020 and 2021. Most of those losses involved crypto investment scams. Finra and other regulators have seen similar trends, with bad actors designing fake crypto trading platforms or running Ponzi or pump-and-dump schemes to drain investors' crypto wallets. As the contours of crypto regulation continue to evolve, we welcome greater direction from Congress and the agency's responses to the President's executive order in this area, which we understand will be due soon. In the meantime, Finra continues to monitor the limited broker-dealer activity in this space. Not all crypto products are fraudulent. Some can be reasonable choices for certain investors. Still, market history is thin, and without clear regulatory oversight, caution is warranted. My third point is that while Finra acts quickly when broker-dealers harm customers, fraud takes many forms and comes from many quarters, often beyond the limits of Finra's jurisdiction or from outside U.S. borders. The research the Finra Foundation and others have conducted suggests that equipping investors to spot and avoid the persuasion tactics scammers use can help. Most investment fraud dangles the possibility of riches without risk. And the bad actors behind these schemes cast themselves as experts. They tell lies to gain trust, and they bombard investors with sophisticated influence techniques like creating a fear of missing out. While the adage, if it sounds too good to be true, it probably is good advice, today's bad actors use sophisticated techniques to make their pitches appear both good and true. We believe investor knowledge is one critical way to prevent harm. That's why we provide free, unbiased resources covering numerous topics, from investing basics to understanding complex products and strategies to avoiding scams and other financial pitfalls. We work with the SEC, state regulators, dozens of national nonprofits, and others to disseminate these materials widely and to reach people where they live, learn, and earn. It's also why the Finra Foundation spends significant resources on research that we share with the public. Just 2 weeks ago, we released the findings from the latest National Financial Capability Study, capturing how the pandemic affected Americans with respect to their financial capability. Our data sets empower researchers to explore financial behaviors, attitudes, and knowledge across multiple demographics. Other studies we have funded examine scam susceptibility and test interventions to help both older and younger Americans alike protect their assets from fraud. You can find more in the appendix to my written testimony and at finra.org/investors. In conclusion, Finra and the Foundation are fully committed to helping Americans build a secure financial future. We stand ready to offer our expertise as Congress tackles tough issues, including how best to approach oversight of crypto and digital assets. Thank you again for inviting me to testify. I'm pleased to answer any questions you may have.
Thank you, Ms. Walsh. Ms. Lubin, Ms. Walsh said that fraud can come from many corners. Your testimony highlights how crypto fraud continues to be a top concern for your member agencies. Elaborate, if you would, on what makes crypto assets so attractive to scam artists and so risky for investors. Sort of walk that through with us.
Thank you, Senator, for that question. One of the things that makes it very attractive to scam artists is that the market is not transparent. So when we educate investors, we say to them, okay, get in touch with your regulator, look the person up, look the promoter up, look the product up. But with crypto, there's no place to look it up. There's no disclosure that's given to investors for them to understand the risks attendant to purchasing that product. There's nothing to say that the market might tank. There's nothing to say that these are the people who are involved in making sure that the market works. So there's no place for them to go to really get information and the material information that they need in order to make an informed decision. The other thing that's really important is that, as Gerri alluded to, scam artists are always paying attention to what's in the news. It's what I like to call the scam du jour. So investors are out there and they're hearing crypto, 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 and they think this is a great idea. And then the scam artists custom tailor their pitches to investors for something that's attracted to them or that they're hearing about, so they think this is a good idea. So they're that more susceptible to being pitched on an investment and investing their hard-earned money into these kinds of products.
Thank you. Ms. Walsh, so taking off on what she said, we know that bad actors often target groups. They read about it daily in the paper, she said, where they can exploit trusted relationships or community ties. This type of affinity fraud is especially destructive because in some sense victims suffer twice. First, they lose their hard-earned money, and then they feel betrayed by someone whom they trusted. How have those frauds evolved in recent years?
In many ways, the frauds have new clothing. Fraudsters can turn on a dime when it comes to changing their pitches, but the fundamentals of the fraud remain the same. People try, the con criminals behind these scams try to gain trust. They infiltrate a community, they build social consensus, exactly to bring down the barriers that an investor might otherwise have to considering the fraud. They gain that trust. It's the use of psychological tactics and persuasion. But we do see that there are frauds that are targeted toward particular communities, and that's why it's so important to reach out to communities, to be in communities where people live and learn and work, so that we can share the information that we have as regulators.
So then, too often the victim is blamed for these losses. Talk through what more can be done to shift the focus on the perpetrators rather than the blaming the victim, as we so often do.
Absolutely, because when we blame victims, when we shame them when they come forward to talk about what happened to them, that actually discourages people from coming forward. And as Finra has found, as I'm sure state securities regulators have found, other regulators, we need people who have been harmed to come forward and complain. We need them to talk about what's happening, because fraud has devastating consequences, not only with respect to financial loss, but there are non-financial elements of loss to financial fraud. That can include lack of sleep, losing a job, losing a spouse. There are all these additional consequences that can't be measured by the amount of money that was lost that can happen when fraud occurs. And so the Finra Foundation has been working with AARP and a research firm to better understand victim blaming and shaming, why it happens, how it happens, and how we can combat it. Just recently, we issued a report on this issue, which is available in the testimony that I provided to you in the appendix. We'd be happy to discuss it further with you or with any members of the committee.
And as victims are shamed, it seems, and going back to Ms. Lubin's comments about the Daily News putting this out here and encouraging the scam artists, and this is I want you both to comment. Start with Ms. Walsh. One of the talking points, and I hear it among, including some of my Democratic colleagues, one of the talking points of crypto proponents is that technology will promote financial inclusion, that the unbanked especially can benefit from this. That appeals to many working families who just don't, as you said, Ms. Lubin, don't trust Wall Street or the financial institutions generally, in many cases for good reason. So my question from Walsh, you would start following the recent collapse of crypto platforms. We've heard stories about significant losses by investors in communities of color. Has financial inclusion using crypto been a realistic goal, or is it just another sales gimmick?
Senator, I appreciate the question, because advancing financial inclusion is one of the most important pillars of the work that the Finra Foundation is doing through investor education. It is critical that we educate people about our financial markets, how they work, what the risks are, so that they do feel comfortable engaging in those markets and they understand the risks that are available. Education is not a panacea. There needs to be clear and consistent regulation that allows for disclosure of important issues so that investors can, in fact, in the crypto space, understand the risks that they're taking, understand how their investments might be used, for example, through lending, and also getting information from the companies.
Ms. Lubin, your comments, and I'll close. Thanks.
Thank you, Senator. As I had mentioned in my opening statement, we have a lot of concerns about the marketing in this space generally. And the marketing pitches are tailored to the recipients of the pitches. So the idea with some communities of color that people are being shut out of the markets and things like that resonates. So the idea that this would somehow democratize investing has been an attractive pitch to people, but it has not panned out to be that way. And unfortunately, communities of color have been disproportionately affected by the losses. Again, it's the opportunistic marketing materials and the pitches by the promoters are really what will resonate with the investor, and the investors that are attracted to that kind of pitch and with whom those representations resonate end up being disproportionately affected by what's happened. So I think really what has ended up happening is, unfortunately for certain demographics, this has been not as much of an opportunity to catch the American dream as an opportunity to become a victim of fraud.
And surely the biggest gainers from crypto have not been people of color. So thank you, Senator Toomey.
Thank you, Mr. Chairman. Let me start by drawing a distinction that I think is important as we consider this. There are applications, there are transactions one could contemplate, transactions we've seen that involve tokens of crypto projects. The transaction which any reasonable person would say that looks like a security and therefore comes under the regulatory purview of securities. That, however, is very distinct from saying that the token itself is a security. So, for instance, you could imagine a transaction. Let's take something that I think there's universal agreement. Gold is not a security. Gold is a metal, and it's a commodity under American law. But you could use gold in a transaction that the SEC would certainly have jurisdiction over. If, for instance, someone were to make an investment vehicle, the repayment of which was denominated in gold bullion, the transaction would be a security. It'd be regulated by the SEC. But it wouldn't turn gold into a security. Gold would still be a commodity. Now, in the last several weeks, we've seen the sensational and terrible cases where companies whose crypto lending services, the activity regarding these tokens, were very arguably within the SEC's purview, and they collapsed. Sensational collapse. Firms were offering interest rates as high as 18% if customers would lend the company their digital assets. Firms, as I mentioned earlier, would then take that crypto, lend it to presumably larger investors who were speculating in the crypto markets. And one of these firms, Celsius, reportedly had nearly $12 billion under management. This is not small. And when the wheels came off and it all collapsed, the customers' funds have been frozen since mid-June, leaving in serious jeopardy the status of billions of dollars of deposits that, frankly, I think many people will not get back everything that they lent. So we have this activity that certainly looks like it's securities activity. The SEC, though, did nothing. They failed to act before Celsius went bankrupt. And that's despite there's press reports that indicate as early as January of this year, the SEC was investigating whether this particular firm was in compliance with securities law. It's under investigation. 6 months later, nothing happens and the firm blows up. Now, I realize that in the face of SEC inaction, a number of states did take action. Securities regulators in various states did take action specifically against Celsius with cease and desist orders that go back as far as last September. I understand Maryland did not. And I wonder if part of that is because really this should have been the responsibility of the SEC to deal with this. So, Ms. Lubin, let me just ask you, do you think that a crypto lending product falls under the jurisdiction of the SEC?
Thank you, Senator, for that question. The state securities regulators have overlapping jurisdiction with the Securities and Exchange Commission over many, many things. And one of those things includes different types of securities. And depending on the type of security it is, will depend on what the requirements are at the federal level and then at the state level. At both the federal and the state level, I believe that these products are securities. We have very similar definitions, and the list within our statutes of how securities are defined are very similar.
So this falls. So you just answered the question that this falls under the SEC's jurisdiction. It falls under the state securities jurisdiction. Unfortunately, no clarity was provided about what constitutes a security, which might have dissuaded people from making the investment in the first place. Who knows how things might have been different if we had had clarity about this. By the way, you may be aware of the SEC's action against BlockFi. It was taking an action for very similar activity. So clearly the SEC had a theory about why this constitutes a security, but yet they never disclose that. They don't share this information with us. Let me move on because I'm running out of time. On the question of the token itself, right, as opposed to a transaction involving a token, let's talk about the token itself. Chairman Gensler has expressed the view that most digital assets are securities. I think he said virtually all of them are actually securities themselves. But once again, he has refused to respond to calls for clarity as to why he comes to that conclusion. And I think there are a lot of good reasons to be very skeptical about the logic. Among those reasons is that a token that's associated with a distributed ledger technology is lacking features that we commonly associate with securities. So for instance, let's look at the Howie test. I went through the 4 criteria of the Howie test. One of the things that a token very seldom has is a specific claim for any return or a specific claim on the income of a project or an enterprise, any specific claim on the assets, right? There's no such thing. But yet, those features, I think, are universal among securities. So in the absence of a commitment by an issuer to provide a return, in the absence of any kind of claim of ownership or assets or anything about the issuer, how does the token meet the Howie test's expectation of profits prong, or even the investment in a common enterprise, if there's no claim on that enterprise?
Senator, thank you for raising that issue. I think when you evaluate a product as to whether or not it's a security under the Howie test, it's the expectation of profits, but the expectation of profits can be the appreciation and the value of the token. So if somebody is purchasing that from a promoter and they expect there to be an appreciation of value, that can meet the expectation of profits requirement.
Except that there's no guarantee of that. There's no claim on the issuer. Can you think of a security that we all acknowledge as a security prior to crypto where there's no claim on the issuer in any form?
I think there are a lot of different types of tokens out there, and you really need to evaluate each one on a case-by-case basis.
Fair enough. And if there's a token out there that does say offer a percentage of profits of the enterprise, or it offers a particular return, then that starts to look a lot like a security. But you're making my point for me. There are different kinds of tokens. They are different from what we have always considered securities to be, and it would be really helpful to have some clarity in this space. And we have none. And that's why, frankly, I think we need to legislate on that, because this is a new category of asset that does not look like all previous categories of assets. And it's a failure of Congress to provide that clarity, and it's a failure of the SEC not to at least provide the clarity of their interpretation, which, by the way, is controversial, is not shared by, say, the CFTC, is not shared by bipartisan folks on the Ag Committee. So I think I see I'm out of time, but I think we need that clarity. I'm sorry I run over. I think Senator Cortez Masto is next.
Thank you. Thank you to the panelists for this discussion. Let me bring it back to, I'm interested in how we address and help investors that are at risk of fraud and some sort of scams when it comes to investments in the crypto and securities market. Since January 2021, more than 46,000 Americans have reported losing $1 billion in crypto to scams. And the average loss was $2,660, I believe. And we also know it is difficult for people to recover their money. You've basically said that here. It is difficult after the money has been stolen and you are now a victim of fraud to recover that money, especially for investors with less than $100,000 in losses. And I think that's what the scammers are counting on, right? In 2009, Finra provided startup grants to law schools to establish investor advocacy clinics in high-need areas. And I understand Finra funded these clinics for 3 years, 2009 to 2012. I am interested in what can be done to help these investors, particularly that have losses less than $100,000, who really have difficulty getting access sometimes to attorneys. I'm curious, Ms. Walsh, can you tell me, was there the successes with these advocacy clinics, or what did Finra learn from providing this type of support to investors who were defrauded or scammed?
I would be delighted to, Senator, and thank you for that question. One of the very earliest grants that the Finra Foundation made in 2004 was to Northwestern to establish a securities arbitration clinic in the state of Illinois that previously did not have such a clinic. And then using the learnings, including the thoughtful guide that the law professors at Northwestern prepared on how to establish a securities clinic like that. We went out with a program in 2009 that continued until 2015. The securities arbitration clinics provide an important vehicle for individuals, particularly people who have low dollar securities claims, so under $100,000. In addition to representing those clients in arbitration or mediation, actually taking those cases to fruition, they provide a very important screening mechanism for people who come to the clinics who believe that something has happened, believe that they have been in some way harmed, and they provide counseling because not all harm is in fact related to misconduct by a broker or by an investment advisor. And so they provide that very important counseling element. And they also provide outreach and education to the community. So we have provided a number of the securities law clinics with resources that they distribute, including an arbitration guide, so that people who do want to represent themselves can, but then also information on fighting fraud.
Yeah, no, I thank you, because I think it is an important service provided. I am actually hearing from our law school similarly that they would like to provide this essential service, and I think it's important. That's why Senators Menendez and Feinstein and I are introducing the Investor Justice Act, and the bill requires the Securities and Exchange Commission to establish a similar grant program for interested law schools to operate investor assistance clinics for the very reasons that you've just said. So thank you. Ms. Walsh, let me ask you this. Recently, and you've talked about some of these types of scams and schemes as well, but recently uncovered Ponzi scheme. We are aware of swindled investors of $59 million under the pretext of at least 5% in weekly returns. And you've both talked about the scams and the schemes that are out there. I guess my question to you is, how can Congress enhance the ability of regulators to pursue these criminals? What else do we need to be aware of that we should be doing to support regulators? And Ms. Walsh, Ms. Lubin, I'm going to open it up to both of you, whoever would like to start first.
Thank you, Senator, for that question. It's really important to make sure that the regulators have the adequate resources in order to make sure we have people in our offices who can pursue these kinds of cases. And we work together at the state level with our federal counterparts, with Finra, depending on the nature of the case, in order to pursue these things. So the things that are really helpful are to help provide additional resources. Like, for example, there's a bill pending called the Empowering States to Protect Seniors Against Bad Actors Act that, along with your clinics bill, would provide additional resources. The seniors bill would place with the SEC the authority to give state securities and insurance regulators additional resources on a grant basis to help fund our offices to pursue matters involving seniors and vulnerable adults. So what's really important is that we have the jurisdiction, we have the freedom, and we have the authority to pursue these actions. So the kinds of actions that preempt anyone at any level, or take state regulators out of it, or limit our authority to pursue these kinds of actions, or frankly, to be the gatekeeper up front and know these transactions are registered or appropriately exempted before they're sold, is really what we're concerned about. Because the more the regulators are taken out of the game and the fewer eyes that are watching over what's going on, the less effective we can be in protecting investors.
And if I may add, Senator, that in addition to my colleague, Ms. Lubin's remarks, in addition to the resources for regulators, it's important to focus on research, too, to understand the mechanisms of fraud, to understand the sort of personality characteristics that lead to scam susceptibility, and to foster networks within the federal government and across state governments to share this information on fraud and fraud susceptibility.
Thank you. Okay, I understand Senator Brown has had to step away. And next in the queue is, I believe, Senator Warner online. Are you there, Senator?
Yes, I am. Thank you, Senator Cortez Masto. And when Sharon comes back, tell him thanks for holding this hearing. And I want to make sure I take advantage of my time appropriately. I know a lot of my Republican colleagues, always cite the Wall Street Journal and, great PR article. I'm not going to waste all the time, but I got 6 recent headlines, all from the Wall Street Journal, who talk about crypto scams and frauds. So this is a timely effort, and I'll perhaps send this around to my Republican colleagues so they can review it as well. I guess I'm going to start with Ms. Lubin and Ms. Walsh on the same theme that I often raise in these hearings, which is I'm still trying to wrap my head around, particularly around stable coins, how they make money. Because if you truly have a one-for-one backing with a dollar per dollar backing, for example, somebody's got to, you're in fact borrowing some of that money from investors or others. You've got to pay for the float. So I don't get how they actually can make enough off of fees, since often people advocates for stable coins, and I want to believe, are saying, well, these stable coins and other tools are going to be used, frankly, as a way to deal with currency risk, payment to third world countries, when in effect it feels like a lot of these stable coins are used as somebody wants to buy a cryptocurrency, they use a stable coin as the tool to invest in another crypto, whether it's Bitcoin or others, or the whole world of DeFi. So to Ms. Lubin and Ms. Walsh, can you explain kind of the underlying basis of how a supposedly one-to-one backed stablecoin actually makes enough money? And if they are making it off of fees, do you feel that those investors in these entities, are getting appropriate enough disclosure to understand the basic economic premise?
Thank you, Senator. I think you raised some very important points. Part of the question is, are stablecoins actually really stable? Is there a way for them for the enterprise to make enough money to back up the entire operation? From what we understand, and there is a tremendous lack of transparency in here, there are fees at each level of the transaction. There also could be excess earnings on the backup reserves for the stable coins, and that's also a place where there possibly is some revenue coming in. But the real issue here is there isn't disclosure. There's a total lack of transparency in this market. So you don't have the kind of information you have with typical securities investments, where you say, this is where we're making money, these are the fees we're going to earn, this is what it costs us to run this business, and this is what we expect the profits to be. So the tremendous lack of transparency here keeps this as an evergreen question of how are people affording to do this.
Ms. Walsh?
Senator, thank you. I echo Ms. Lubin's comments and underscore that more disclosure, greater clarity is needed with respect to crypto assets and digital assets. Market forces can drive up the value of various securities, and that's something that we've seen time and again in different iterations over the years. I've been doing this for 25 years, but having clarity and more disclosure so that people understand what the product is, how it works, what the fees are, how they might incur losses, even if those losses are caused by something other than a market decline in the value of their particular security. Those are all important questions for regulators and Congress alike to be tackling.
Yeah, and I appreciate both of them, because again, I could see a stable coin world where you might have, within the universe of so-called algorithmic stable coins, where there's not this promise of one-to-one backing. And, and clearly we think about, I always think about It's a Wonderful Life and Jimmy Stewart, telling folks, when the run on the savings and loan will, your money's in somebody else's house. Again, if there was not this promise of a one-to-one backing, some level of leverage on stablecoin usage makes sense. But when people are saying, no, we have an immediate one-to-one backing on a dollar or other similar legitimate currency, I just think the business model needs a lot more review. And I know, Ms. Lubin, my time's up, but I'm 100% with you. The idea that anywhere in this field, this early on, that we would have any kind of self-regulatory or SRO organization would be absolute lunacy. I appreciate this, and I really hope we get more chance to investigate. I also hope that we could maybe do this. The committee could maybe get some kind of classified briefing. As chairman of the Intel Committee, I think there are a number of misuses in this field that needs to be explored. My understanding is I've been handed a note that I'm now supposed to call on my colleague, Senator Menendez, who I think is next in the queue.
Thank you. I was happy to yield to my colleague from Virginia since he needed to go. Crypto scams have real impacts on hardworking Americans. In my state of New Jersey, a retired police officer lost $15,000 of his savings in a long and complex crypto mining scam. According to the Washington Post, blockchain records reveal that the scammer conned over 5,000 people for over $66 million. And that's just one scam operation. The FTC estimates $750 million were lost to scammers in all of last year. Victims have tried to contact law enforcement, but many have yet to receive the help they need. There's a real concern that these scams are not being adequately investigated, leaving the victims with no recourse. So, Ms. Lubin, if someone falls victim to a crypto scam, who should they contact to seek justice?
Thank you for that question, Senator. It is really important, and sometimes it takes investors a little while to figure out whom they should call to get some help. We strongly recommend that you start with your state securities division. We are the local cops on the beat. As we like to say, if you're mugged, you're not going to call the FBI, you're going to call your local police department. So if somebody has a securities issue or an investment issue, they should call their local securities divisions, and they can find us by checking on the NASA website. We do work with our federal counterparts. We have jurisdiction over, and all the states work this way, we have jurisdiction over securities whether they're sold from our state or they're sold into our state. So we have very broad jurisdiction, and we frequently have to work with our federal counterparts because things might be national and things might be international.
Mm-hmm. What is it about cryptocurrency that is causing difficulties in prosecuting crypto scams?
Another very good question. I think what's difficult is, first of all, it's a new area. So people need to, and people are gathering their expertise and understanding what's going on. It also takes a little bit of time for the investor complaints to catch up with, to actually be reported to the appropriate regulators and the appropriate prosecutors. So there's this ability, and we see this in cases all the time, for investors to be lulled into believing the money's going to come, and they are worried to file a complaint because that might interfere with their ability to collect. So you will see some of the cases trailing behind when the fraud happened because the promoters and the scam artists convince the investors that they shouldn't go to regulators.
Mm-hmm. Well, this is an area that because it's happening, police officer is not the typical person in terms, his antenna would normally be up. He's someone who's trained, and yet he fell victim to it, and that's just a reality of so many. Let me ask you both. For years now, I've been calling out social media giants such as Facebook, Instagram, WhatsApp for their failure to curb the spread of misinformation on their apps. And study after study, for example, in the Spanish-speaking community, 66% of Spanish-speaking respondents receive wrong or harmful information about the COVID vaccine. But that's true about so many other things. How does the spread of misinformation on social media magnify the problem of crypto scams?
Thank you, Senator, for that question. Social media is a powerful medium that has wide reach, and there are a lot of individuals who are using it to promote either their own brands or products. So it is widely used and widely accepted and very available to the American public. And we do see, I know that state securities regulators have listed as one of their top scams, the rise of social media as a mechanism for fraud. And while much of this fraud is happening outside of broker-dealer spaces, so that it's beyond FINRA's regulation, FINRA's jurisdiction, FINRA is monitoring social media for crypto and other scams, and we recently launched a Finfluencer sweep to try to better analyze how broker-dealers, to the extent that they're using social media to acquire customers, what is happening in that space. So this is an area that we take very, very
I
seriously.
see it in my Instagram account all the time. I just say to myself how easy it is if you don't know, which brings me to my final question of the time I have. Digital assets are relatively new, and unfortunately, scammers can take advantage of the novelty to mislead investors. It's clear that the technical knowledge required to really understand crypto can be a challenge for an average investor. Ms. Walsh, do you think that the lack of education on digital assets is a contributing factor in their rising use and scams?
Senator, I agree 100% with you that we need more education on digital assets so that people understand how they work. They know what disclosures to look for, and in the absence of those disclosures, to exercise caution. It's very important that people understand how a particular investment works, how they could lose money in that investment, what they pay for that investment, and what recourse they have. Because since most of the digital asset transactions are happening outside of the broker-dealer space, protections that come from FINRA's regulatory regime don't apply. And that's the concern for all regulators, is that when this is happening outside of the space of regulation, the recourse for investors can be difficult.
Yeah. According to the FTC, reported losses in 2021 due to crypto scams were nearly 60 times what they were in 2018. So it just speaks volumes. I understand that Senator Loomis is next.
Thank you, Mr. Chairman. The point you just made, Mr. Chairman, is indicative of the fact that we need a strong consumer protection in the digital asset space. Consumer protection in the digital asset space will take a lot of forms. It includes robust disclosure made by companies who create digital assets, legal segregation and protection of customer assets in bankruptcy, and disclosures made by digital asset exchanges about the risks and permissible transactions that may be undertaken with digital assets. We have that framework for robust consumer protection standards for digital assets, and I believe my Responsible Financial Innovation Act with Senator Gillibrand achieves that across the board. I look forward to working with Mr. Chairman, the ranking member, and other members of this committee to ensure we get this right. Ms. Lubin, thanks for joining us today. The Securities and Exchange Commission has previously stated that digital assets can transition their legal status between securities and commodities, and that digital assets may or may not embody an investment contract depending on the facts. Far from being settled law, this is the first time in the history of the SEC that it has taken that position. I know this because my staff has reviewed hundreds of circuit and district court cases on the Howie test. We need to have an honest discussion on this committee about what the Howie test does and does not mean. So, Ms. Lubin, do you think there are significant investor protection issues when market participants cannot effectively tell the difference between a security or a commodity, especially where the SEC has acknowledged that their legal status can change?
Thank you, Senator, for that question. Clearly, it's very important for people to be able to assess and determine whether something's a security. But when you have a securities lawyer look at the products that are being sold, we understand what the Howie test is, we understand how it's applied, and we can look at it and say, yes, that looks like a security. It's not just, the Howie test doesn't only apply to crypto, it can apply to any kind of investment. So our job is to take the law and to take the facts and take the case law and the statutory law and apply it to what's going on in a given situation. And most securities lawyers would take a look at that and say, yes, that is an investment contract and it needs to be regulated.
Well, I would welcome your review of the Lummis-Gillibrand bill and your comments on how we addressed it in the legislation. Ms. Walsh, thank you for being here today. As the primary self-regulatory organization in the securities space, does Finra believe a role for self-regulation should be part of the conversation around digital assets?
Thank you for that question, Senator. Finra has not taken a public position on whether there should or should not be a self-regulatory organization in the digital asset space, but I will say that the self-regulatory model that Congress enshrined in the federal securities laws when it passed the Maloney Act has led to robust regulation in the broker-dealer space. Finra and its predecessor organizations have been registered and in fact are overseen by the Securities and Exchange Commission. There is robust oversight. So while self is in the name, the legislation that Congress passed did not envision that Finra would be solo in regulation. We absolutely are overseen. We also, the way Finra is set up, we have a majority public board. And so we are informed by, but not influenced by the industry that we oversee. And I think that's another important element that sort of contributes to continued investor protection. So Finra would be delighted to work with you, with other members of the committee on legislation, and to share our expertise and our history with the self-regulatory model.
Well, I would welcome that as well. We want to get this right. Senator Gillibrand and I want to make sure that this piece of legislation we have that's very comprehensive, but that has jurisdiction that spreads across multiple committees in the Senate, has been thoroughly vetted, and that we can piece it together. Does FINRA feel that it would have a role in the digital asset SRO, or do you think an SRO that's specific to digital assets would work better?
Again, Senator, thank you, but we haven't come out with any kind of position on that. However, most of what is happening in the digital asset space currently is happening outside the broker-dealers. Yeah. Within broker-dealers, Finra has robust examination mechanisms, review of advertising materials, review of customer communications, tools at its disposal, because those are part of our regulatory toolkit. And so we would offer those as you're considering the steps to take.
Thank you. I thank our witnesses, and I yield back.
Thank you, Senator Lummis. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So crypto has made it faster and cheaper than ever before to rip off consumers. According to the Federal Trade Commission, since the start of 2021, about 1 in every $4 that consumers were defrauded out of, totaling about $1 billion, was lost in a crypto scam. And those are just the scams that are reported, not the ones that people are too ashamed to tell anyone about, or the ones that people never report because they know the money's gone and it just doesn't feel like any point in it. Today is about scams, but crypto is not an industry with a few scam artists operating around the fringes. Crypto is an industry that is built to favor scammers. And some of the biggest players in our financial system are in on the con. Venture capital, giant hedge funds, and private equity rake in profits from a system that's designed to reward insiders and to defraud mom and pop investors. Now, Ms. Walsh, you are an expert on protecting mom and pop investors. So I'd just like to ask you who those mom and pop investors are up against. Are big institutional investors becoming more prominent players in the crypto market?
Thank you, Senator, for that question. While the Finra Foundation focuses on retail investors and has information about retail investors, we've certainly seen from media reports that there are large investments by institutional investors and hedge funds and other entities.
In fact, I have some of the data. VC firms invested $33 billion in crypto-related companies last year. That's more than all the previous years combined. And hedge funds and other big investors are now the main source of trading activity. Last year, professional investors traded $1.1 trillion on Coinbase, more than double the amount retail investors traded. In other words, some of the biggest players in our financial system, these so-called smart money, are all in on crypto. Now, two companies that these big investors poured money into recently were Voyager and Celsius, which, as it turned out, both of them filed for bankruptcy earlier this month. Celsius, for example, announced raising $750 million from professional investors just months before it collapsed. Ms. Walsh, Voyager and Celsius made money by taking people's deposits and lending them out, a lot like a traditional bank. But they made astonishing claims, like offering up to 20% interest while claiming that they were FDIC insured and, quote, safer than banks. Does that have the earmarks of a scam to you?
Senator, I appreciate that question. And if that were happening within the space of broker-dealer regulation, Finra would be able to look at the advertising because that's what we do. We would be able to look at the disclosures because that's what we do. It's important to have clarity in the digital assets.
Well, I appreciate clarity, but let's be clear here. No risk, 20% returns. Look, that it was a lie from the start. It doesn't take a lot of deep analysis to understand what's going on here. But notice, it did not stop big professional investors from throwing money at crypto firms that were clearly drawing in mom and pop investors in a scam. So, Ms. Lubin, do you think that mom and pop investors who handed their money over to Voyager and Celsius are likely to be at the head of the line in getting their money back during the bankruptcies of those companies?
Thank you, Senator, for that question. And I wouldn't presume to tell you how bankruptcy law works. On the other hand, if those investors are considered unsecured creditors, they're going to be put into the pool with everybody else, and they're typically at the end of the line. I have some other theories, and there are other things being litigated, so I'm going to invoke investigative privilege and not discuss some of the other approaches that investors' counsel might want to take in some of those cases.
Fair enough, but this is going to be tough, right? They are not,
I think
as you say,
I think it's an uphill battle.
That's right.
I'm sorry to interrupt. I think it's an uphill battle, and there's always an uphill battle in bankruptcy or when we put cases into receivership because there's rarely enough money to cover the investor.
Right. Across the crypto market, these big investors are funding, hyping, and then vampire sucking money out of crypto projects that scam mom and pop investors. Regulators need to protect customers from cyber criminals, from grifters, from other illicit characters that are scamming consumers from the shadows. But these shadowy actors shouldn't distract us from the big, seemingly legitimate players that are financing crypto and helping crypto attract the mom and pop customers who are going to lose their money. And that's why I will soon be introducing a bill to regulate the crypto market and stamp out the worst scams by scam artists, both big and small. Thank you. Thank you, Mr. Chairman.
Thanks, Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman, and thank both of you for your testimony here today. Ms. Lubin, it's great to have you here, both with your national hat on, as well as I want to thank you for your work as our Maryland Securities Commissioner. Great to have a fellow Marylander here. And I want to start by thanking you for your input and advice as I worked to introduce the Empowering States to Protect Seniors from Bad Actors Act. And I believe you may have mentioned that this morning in your testimony. I think we're all well aware of the fact that a lot of these fraudsters prey on seniors. In fact, we know that according to the Senate Special Committee on Aging, seniors lose approximately $3 billion each year to financial scams. So I know you worked with us to put this bill together. It's bipartisan. I want to mention to the chairman and the ranking member that we have the support and sponsorship of Senators Scott, Warnock, and Loomis. I hope we'll be moving forward on this. Could you, Ms. Lubin, just talk to why it would be important to pass this bill?
Thank you, Senator, and thank you for your comments and for sponsoring the bill. The bill is really important to us. There are never enough resources to go around with what we do. Industry, scam artists always have way more resources than regulators have. So this grant program would allow state securities and insurance regulators to apply for a grant to help us in combat fraud in the senior space. And it would allow us to get more resources, have more attorneys, have more investigators, and have more people who can do investor and senior outreach to try and help protect seniors and prevent fraud.
Are there investigations that you might want to pursue now that you're not able to simply for lack of resources?
We always have cases that we can continue to pursue and pursue more in depth that we can't because of lack of resources.
Yeah, just to my colleagues, what the bill does is provide a grant program, $10 million a year, I believe, to the SEC for states to develop programs and use their resources to crack down on fraud against seniors. And this would apply to fraud in the crypto space, would it not?
It would apply to any kind of fraud involving seniors. There's a NASA Model Act to protect seniors and vulnerable adults, and financial professionals who believe that there's been exploitation have a legal obligation to report to us and to Adult Protective Services the fact that there might have been or they believe there was exploitation, and this kind of grant money would help us resource those activities for us to investigate and prosecute those cases.
I appreciate that. I hope we'll get that over the finish line here in this committee. We've had a number of hearings on the risks of different crypto assets, but I'd like to ask you both about what authorities exist, if any, with respect to deceptive advertising. Senator Warren mentioned a couple of examples. It's hard enough for people to assess the risks of crypto without deceptive advertising. And obviously, some folks in the crypto space provide information and disclosures, but many do not. So where there are cases of deceptive marketing, Ms. Walsh, do you at Finra have, what kind of authorities, if any, or what kind of practices do you have in place to try and track and expose and hold people accountable for deceptive advertising?
I appreciate that question, Senator, and I appreciate the opportunity to talk about what Finra does in this space because we do take deception very seriously. In addition to ongoing risk monitoring activities of our firms and examinations of the firms on a regular cycle, Finra does review advertising materials that are used in the sale of investment products. And so we do have an advertising review team that takes actions when we see issues. Certainly, to the extent that crypto is happening within the broker-dealer space, one of the things that we look at are the advertisements themselves, whether those are being filed with Finra, and also the nature of the communications with the public that are being made, because under Finra rules, those have to be fair and full and not misleading.
And have you taken any action to date against anybody for deceptive advertising in the crypto space?
I will have to defer to you. I will have to defer to my colleagues at Finra. As I sit here today, I am not aware.
Okay. Ms. Lubin, as a state regulator, what kind of legal powers do you have to go after deceptive advertising?
Thank you, Senator. I and my colleagues, across the board, most of our statutes are based on the Uniform Securities Act, are very similar to federal law, and we have anti-fraud authority that applies to any person. So any person in connection with the offer or sale of securities who commits a fraudulent act or makes material misrepresentation or omissions falls within our jurisdiction. So if someone is advertising and in a misleading way or has material omissions, those are offers of securities, and we would have jurisdiction to take action against those advertisers.
Well, I appreciate that. I think one of the concerns is that some advertisements suggest that, for example, investors in crypto have the kind of coverage you do through the FDIC for your deposits, which we all know here is not true. But I hope both of you will be on the full lookout, obviously for deceptive advertising across the board in your areas. But because there's such confusion in this particular space of crypto. I think it's especially ripe for deceptive advertising. We need to be on the lookout for it. And again, thank you, Ms. Lubin, for your help on that bill, and I'm confident the chairman and the ranking member will help get it passed out of the committee. Thank you.
We hear you. Thank you, Senator Van Hollen. Senator Sinema is recognized from her office.
Thank you, Mr. Chairman, and thank you to the witnesses for being here today. Last year I worked with my friend Republican Senator Cynthia Lummis of Wyoming to co-found the bipartisan Senate Financial Innovation Caucus. The caucus strives to highlight responsible financial innovation in the U.S. financial system and how financial technologies can make markets more inclusive, safe, and prosperous for Arizonans and all Americans. Arizonans are optimistic about blockchain technology, and they're interested in how the technology can make their lives easier. But as my friend and hero, Senator John McCain, would put it, Arizonans have no patience for hucksters, those who are looking to rip off everyday people to make a quick buck. When Congress fails to do its job and provide for a thoughtful, clear, and strong regulatory framework for blockchain technology and its financial use cases, it's not just entrepreneurs that lose, it's everyday Arizona investors who have no idea what to expect from a business or from their government. We have enough uncertainty in the world as it is. People are tired of the chaos. So we need to provide safeguards and information to investors in this space so they can make informed financial decisions for themselves and their families. So Ms. Lubin, thank you for being here today. Your organization, NASA, has conducted a survey for several years and found that investments tied to digital assets are a top threat to investors. This space is basically unregulated. At a basic level, can you tell me why unregulated investment spaces are threats to retail investors?
Thank you, Senator, for that question. When the investment area isn't regulated, that means we don't have the ability, first of all, to be a gatekeeper to see those offerings before they're sold, and investors don't have access to the information that they need to make an informed investment decision. So they won't get the typical disclosure that you get with a regulated offering or an offering in the public market that says these are the things you need to think about. These are the risk factors. This is how you're expected to make money. There isn't transparency, and that, frankly, is our concern when you're dealing with the public versus the private market, that there isn't a way to look into that market and for investors to get adequate disclosure, and frankly, for the market to get adequate disclosure so they could affect the pricing. So when these kinds of investments end up in the private market, there's not transparency, there's not liquidity, and people, investors really do not understand what's going on with their investment the way they would in the public reporting market where you get quarterly and annual reporting.
Thank you. So let's talk about the harm that a lack of regulatory clarity is causing consumers. We recently saw that Celsius, a crypto lender that made some splashy promises about being superior to traditional bank lender, filed for Chapter 11 bankruptcy. Prior to doing so, Celsius had suspended the ability for customers to access their holdings, which effectively trapped consumers in place. Consumers who utilize Celsius are panicked because they rightfully believe that the Chapter 11 filing will free Celsius of its obligations to make good on its promises to consumers, costing them thousands or even their life savings. Now, Ms. Lubin, many of these consumers may be considered unsecured creditors in a bankruptcy proceeding. Given the cash shortfall that Celsius has publicly reported, are they right to be worried?
Thank you, Senator, for that question. I think the investors are very appropriately concerned. Some of our states, and NASA now is working on a piece, an investor education piece that will be helpful for investors so they understand what they might be facing with a company and a platform that files bankruptcy and what their options might be in the bankruptcy case. So it is appropriate for them to be concerned, and it's also appropriate for we as regulators to try and assist those investors in figuring out what their options are as they move forward.
Thank you. Now, Ms. Walsh, thank you for being here. From a financial education standpoint, what role could easy-to-understand consumer disclosures and a consistent regulatory framework play in reducing the instances of fraud and financial abuse in crypto and securities markets?
Senator, thank you for that question. Fundamentally, there are, multiple pillars of regulation, examinations, enforcement, and education. And so, there, to the extent that there is clarity in the disclosure about the disclosure obligations that crypto and digital asset providers are making, that will assist consumer knowledge, because not only is that information absorbed by consumers, but it is also absorbed by the market itself. And it's important that we have transparent information available about companies so that investors and any intermediaries that might be guiding them are able to make fully informed decisions. And investor education is a complementary tool to the disclosure that regulation requires. And so, we work collaboratively with our fellow state securities regulators, with the Securities and Exchange Commission, many other federal agencies, and a network of national nonprofits to get the word out as widely as we can about the tactics that con criminals are using to separate people from their money, including in the digital asset space.
Well, thank you, Ms. Walsh. Consumers are angry, confused, and frustrated. MarketWatch reported that one customer now has less than $1,000 left in a checking account to support his family after Celsius froze all withdrawals. Another lost his farm, and his family was left homeless. These are real losses. And while losses are a real risk in any type of investing, losses at this scale to consumers who may not have understood what they were getting into is a failure in governance and a failure in policy. We've got to hold hucksters accountable and strive to do better. And let's be honest, Celsius is far from the only recent failure in our crypto markets. These companies built businesses predicated on transparency and accountability. But for too many Arizonans, the experience with these businesses no longer feels transparent or accountable. So we have to find ways to repair and restore that trust while continuing to spur innovation and to create opportunity. Earlier this week, I introduced the Virtual Currency Tax Fairness Act with my friend Senator Toomey. This common sense and bipartisan legislation provides much needed clarity for everyday transactions with digital assets. It creates a de minimis exception of just $50, much like we have for foreign currencies, to ensure that Arizonans aren't caught having to pay a surprise capital gains tax when they're just trying to buy a cup of coffee with their crypto. But so I'm hopeful that our legislation and other conversations that Congress is having on regulation of stablecoins and other important subjects can result in new laws that protect consumers from scams and, importantly, provide the certainty that innovators need to build the next big thing. So I'm looking forward to us getting to work. And thank you, Mr. Chairman. I yield back.
Thank you, Senator Sinema. Senator Reed from Rhode Island is recognized if you're ready. Would you like to hold a minute?
I defer?
Sure. And you want to make a little statement?
Well-
And Senator Reed will go, and then I'll just close it.
Thank you, Mr. Chairman, and I don't know that I'm going to take enough time for you to fully prepare there, Senator Reed, but a simple observation. During the course of the hearing, I think on several occasions, there has been a discussion about the lack of disclosure regarding the assets backing a stablecoin. Ms. Lubin specifically referenced the absence of appropriate disclosures, which is very often the case. I just want to say, for the record and for my colleagues' benefit, my stablecoin legislation, which is not meant to be the final word on this, it's meant to be a starting point, requires full disclosure so that everyone would know exactly what's backing a stablecoin. You would be able to see exactly what's there. Furthermore, it creates a mechanism, it creates a regulatory obligation on the part of the OCC to regulate these stablecoin issuers. There is no statutory authority to do that now. Part of the problem we have is the absence of legislative authority for regulators to do the things that I think we all agree need to be done. So I appreciate underscoring the need to have this transparency about these assets. We've got a legislative proposal that does it. Thank you.
Thank you, Senator Toomey. And Senator Toomey and I have talked about this. We have a different view generally about the lightness of the touch of regulation or the more onerous touch of regulation, if I can put those polls out there. But we want to get to that, and we want the regulators to go as far as they can go, and these conversations will continue. Senator Reed from Rhode Island.
Thank you very much, Mr. Chairman. Ms. Lubin, with Senator Menendez, I introduced the S3990, the Insider Trading Prohibition Act, which would finally define the offense of insider trading by making an offense for those who contribute to a securities market rigged in favor of the well-connected. Our legislation focuses on providing everyday investors with a fair shot at seeing some returns. How would securities regulators, professional traders, and retail investors all benefit if Congress were to clearly define the standards for insider trading liability?
Thank you, Senator, for your question. And NASA supports your legislation, the Insider Trading Prohibition Act. We think it's important that there's clarity so people understand what is and what isn't insider trading. And insider trading, in my experience, is a very significant inhibitor on investors' ability to make money, because if somebody has information about what's going on, they'll trade ahead of the investor's ability to trade because they've got information that's not out in the public market. And that situation really disadvantages individual investors. So we think it's very important that people understand what is and isn't covered under insider trading, and that it gives the regulators clarity, the prosecutors clarity, and the industry clarity about what they can and cannot do.
Well, thank you. Ms. Walsh, the biggest U.S. platforms for retail investors to trade cryptocurrency operate outside of the securities regulatory structure. None of these platforms are registered with the SEC or a state as a broker-dealer or a securities exchange. Instead, they rely on state money transmission licenses. And this regulatory approach strikes me as untenable because it's implausible that not a single one of the assets listed on these platforms is a security. How would getting cryptocurrency trading platforms registered as broker-dealers or exchanges help security regulators do their jobs? And how would registration result in stronger investor protections?
Thank you for that question, Senator. The federal and state securities regulatory regimes that exist in the United States have fostered investor protection and the integrity of the market over the years since they have existed. So bringing crypto and digital assets into that space of regulation could have extraordinary value for consumers and for the markets themselves. To the extent that you have disclosure, and our system is based on disclosure, that's full and fair and not misleading, that adds value to our securities markets.
Thank you very much. Ms. Lubin, with Senator Grassley, I've introduced S2147, the Stronger Enforcement of Civil Penalties Act. And this legislation would increase the size of the penalties the SEC may impose and authorize the agency to triple the penalty cap for repeat offenders. The recent cryptocurrency meltdown has revealed a shocking number of Ponzi's and frauds, even among the largest participants. And the scale of the damage is staggering. For example, an unlicensed crypto bank called Celsius has failed and owes its users more than $4.7 billion. A crypto lender called Voyager is in bankruptcy, and its liabilities are in a similar range. Thousands of customers have had access to the money frozen, and they are at the mercy of a long and uncertain bankruptcy process. How would this legislation empower the SEC to better protect the investing public from these kinds of bad actors who may defraud and scam them out of their very hard-earned money?
Thank you, Senator, for that question. We think it's important that regulators have multiple tools that we could use in order to try and protect investors. And the idea that penalties could be enhanced and fines could be higher for recidivists and for other actors, I think is another tool that we will have to discourage bad behavior. I think part of the problem that we've seen over the years, and I've been doing this for many years, is that a lot of the industry considers penalties to just be the cost of doing business. And those penalties need to get into the range where they're high enough that it provides a deterrent for bad behavior.
Well, thank you very much. Just one final point, and that is that we've noticed that a lot of private equity firms are going down the ladder in terms of income and disposable income particularly, not just the very rich, but down to what they call the mass affluent, which is an interesting terminology. So it raises the question about who counts as a retail investor, and it's blurred the lines between public and private markets. Any comments on that?
Thank you, Senator, for that question. I think that really points out the issue we have with the difference between the public and the private markets. And the private markets are not transparent. Investors don't get the kind of information they get in the public markets. But because of the accredited investor definition and the really low dollar value that's attached to that definition that has not been modified in the past 40 years, There are investors who are able to avail themselves of the private markets that really should really not be in there. They should be in the public markets where they have a much better chance of making money. There's more liquidity and there's much more transparency and less complexity into the investments that they're purchasing.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Senator Reed, and thanks for coming back from your chairmanship. So thanks to our witnesses today for their testimony. We appreciate the work you do. All of us must continue to put protecting families and workers and our communities at the center of our financial system. For senators wishing to submit questions, they're due 1 week from today, Thursday, August 4th. Witnesses will have 5 days to respond. If you would please do that. Thank you again. The hearing is adjourned.